the popular safe investment product, post-retirement products are these. One, immediate annuities. You have 1.66 crore, give it to LIC and earn a check every month. It's a horrible idea. I'll explain later. Second, senior citizen savings scheme. It's not a bad thing. This is okay, but there's a bit of a problem there. Then monthly income plans, as they call. These are all mutual fund schemes. None of these are great choices, and I'll explain. The immediate annuities, payment starts immediately. It's like give them the check today, they process the paper, and you start getting your monthly annuity payments. Annuities are a 1900 product when there was no other options available. When life insurance companies were really the investment companies to go around, there were no mutual funds. Stockbroking was all, sham and crookedness. 2 hours of work in the afternoon, stick those guys with all kinds of Dutch shares, make 2.5-3% from them, and so on. All that has changed. Today you have mutual funds, and you can invest in high quality stocks all by yourself in a fairly safe manner for a long period if you have behavioral traits worked out correctly, which is if you don't get swayed by highs and lows, and if you don't listen to sort of tips, and you don't don't ask around what to do, and do your own work. Good high quality stocks, 10-15 years, you're going to come out very well. This wasn't very easy to do earlier. There weren't many high quality stocks to buy at all. Life insurance companies will give you an annuity on an average of 4.5-5%. I've generously put a figure of 6%. This is far worse than anything that you know. And the only thing you know is bank FDs, which is 8.4%. It's fully taxed. Several people have tried to approach successive governments, the last one being Pranab Mukherjee, and said that annuities, who buys them? Senior citizens, they don't have any other source of income. Why not make it tax-free? So it's in that context that what Sucheta mentioned, that Pranab Mukherjee said, our priorities are those who do not get 2 square meals a day. You are the creamy layer who can buy annuities. Get lost. So annuities continue to remain taxed. If you get 3 to 6% as income, and if it is taxed, you have to of course look at your condition, whether you are in the taxable bracket or not. If you are in the 10% taxable bracket, it comes down to 5.38%, and I've assumed 6% very generously. If you're in a 20% tax bracket, it comes down to 4.76%. If you're in 30% tax bracket, it's just 4.15%. Who on earth would want a product like this? Certainly not who are in the 20 and 30% tax bracket. Not even those who are in the 10% tax bracket. 5% is like savings account. Not even FD. All right? So that's the problem with annuities. Senior citizen savings schemes are better because interest rates are a little higher, but this is a little old figure, 9.3%. This figure has come down a little bit. But you can invest only up to 15 lakhs. Certainly not 1.66 crore. Okay? Maturity of 5 years, you can be extended only for 3 more years. So it's not a long duration product. It's not a long-term product. You can't hold this like stocks or equity mutual funds forever. Or 15 years, which I talked about, or 20 years I talked about. And it is taxed. So post-tax, these are the effective rates if that is the rate. Same problem as annuity, slightly better, but there are serious problems in terms of the amount you can invest and the period you can invest, and it's locked in.
These are mutual funds or these?
No, these are sold by banks.
They're fixed deposits.
Yeah, fixed deposits. Then come monthly income plans, which are sold by mutual funds. They are funny products. They primarily invest in fixed income, but they want to give you a little boost of equity. So there's an 85% in fixed income and 15% in equity. Now, what are you going to do with 15% in equity? It's neither here nor there. You're not going to get the returns of equity, and you are exposed to the risks of equity. For somebody who is risk averse, for them it's a horrible product. I don't know whom it is meant for. Those who are risk takers certainly will go into mutual funds. And separately, as I said, invest in bank fixed deposits, invest in equity mutual funds, get a blended return. If you want to do it through MIP, this is what you get, 85-15. Now, the problem is that this is not a fixed income product. Nobody gives you a check at the end of the month or at the end of the quarter. This is a capital product. It's like shares. It's like bonds. So you get an NAV which goes up and down, linked to the underlying value. That underlying value moves up and down like shares. Not as volatile, but certainly volatile, because the MIP does not invest in a fixed income product to give you a fixed check every month. So in that sense, it's neither monthly nor income. And it's a funny kind of a plan. It is taxed like a because it's a capital asset, like shares or bonds. It is taxed under the capital gains tax. It's not taxed as an interest income. If you invest money in bank FD, you get a interest check. Taxed or not taxed, it's an income. This is not an income. This is gains or losses, like shares. And it's got its own set of rules. And those rules are, below 3 years, it is fully taxed. Alright? At the slab rate. So if you're on 10% slab and if you have made a gain, that gain will be added to your income and you will be taxed 10%, 20%, 30%, depending on which slab that you fall. More than 3 years, you are taxed at 20%, with the cost of this going up as an indexation element included in it. It's just like a real estate. You bought a flat today, you sell it after 3 years. If you make a gain of 1 lakh rupees, suppose you bought a flat at 20 lakhs. 3 years later at 25 lakhs, you make 5 lakhs of gain. You will have to pay 20% tax on that 5 lakhs. But there will be an adjustment to the cost. So it won't be a 5 lakh gain. Your 20 lakh cost of the flat will be adjusted upwards because there is inflation. So suppose it is 22. So your actual gain is only 3 in the eyes of the income tax department. So you pay tax on the 3 lakhs. That is called, this adjustment of your cost going up with inflation is called indexation. That the same thing applies over here. The big problem with this is that 85% of it is invested in fixed income products which may be market linked. Now, how does that affect us? Assume that 85% it is invested in bonds. If interest rates go up, bond prices go down. Like shares, they go up and down. So if you are in a 3-year period when interest rates go up and also share market goes down, so your 85% will be at a loss, your 15% also be in a loss. There are periods when MIP has given 2% return. 3 years, 2%. It's in the nature of that product. In some 5-year period, they have given a return of 11%. So the returns have actually on an average varied between 5 to 12% over 3 years. Okay? This is the... Sorry.
These incomes you're talking about at the end, is this on exit or is this on the monthly income? Or there
is no monthly income.
There is no monthly income?
No, it's like real estate. You invested, you holding it, you sold. If you sell it before 3 years, there's a certain tax rule. If you sell after 3 years, there's a certain tax rule. On a gain, you will pay a tax.
But they're not giving you a check at any...
No, nothing at all. They're not giving any check. They'll return your money with profit, with loss, whatever the situation is, depending on the period. It's like shares. It's like shares which don't go up and down much. It's like that. This is how financial industry works. They know what is the hook for you The most brilliant advertising in this country is done by a government organization called Life Insurance Corporation. I know exactly what the hooks are so that people fall for it.